Today, I'm going to be talking about 5 financial goals that you should hit before the age of 50. Goal number 1 is to establish an emergency fund. An emergency fund is exactly what it sounds like. It is a fund set aside for emergencies, whether you have a medical emergency, or if your car breaks down, or if you have a water line burst inside your house. You want liquid assets that you can readily get access to. A common mistake that we see a lot of people make is that instead of leaving this into a high yield savings account or cash, they will invest it in CDs. And CDs, while you can sell them and you might have to give up some type of interest by selling those early before they mature, they're not quite as liquid as cash. So we recommend that our clients open up a high yield savings account somewhere outside of their normal bank, so there is a separation between what they spend for their daily operating needs versus what they need to set aside for short-term goals or an emergency. And you can do this at Ally, you can do this at Marcus. American Express has a great one. And right now they're yielding right around 4 to 4.5%. For our clients here at Bull Oak, we offer a 5.1% high yield savings account. It's probably among the highest that I've seen out there, but do your own due diligence, see what options are out there. The important thing is not necessarily getting that really high yield. A high yield is very nice, but the important thing is actually setting those funds aside where you can grab it within a day or two's notice. Also, at this stage of your life, you should be contributing to an after-tax brokerage account above and beyond the 3 to 6 months for your emergency fund. So once your emergency fund is fully funded, right, this should be really step 1 on your order of importance. You should be contributing to an after-tax brokerage account, whether that's an individual account, a joint account, whatever the registration may be, and actually investing in the markets. But step 1 before you do that should be establishing this emergency fund. Goal number 2 is to not carry any credit card debt. If you're trying to build true financial wealth, debt is not the way to do it. So there's a very bad misconception out there to where if you were trying to improve your credit score, you should be paying the minimum monthly payments on whatever balance that you hold. That's not true. Do not hold any credit card debt beyond the 30 days whenever your payment is actually due. Just pay it off every single month. You should be having a credit score right around 800 at this stage of your life. And if you are holding a balance longer than the 30 days, that's seriously going to be damaging that credit score. So pay it off. Don't carry credit card debt. And this is also true for any type of consumer debt. So if you have like a Home Depot credit card or your favorite shopping center like a Nordstrom card, it's okay to have those credit cards, but make sure you don't carry any balance on them. Goal number 3 is to have a robust investment strategy. At this stage of your life, you should not be YOLOing your investment account. You shouldn't just be buying random stocks or high-flying tech stocks that you think are going to go up, or what you see on CNBC and listen to Jim Cramer.
Don't move your money from there. That's just being silly.
You should be investing in low, tax-efficient, diversified index funds at this stage of the game. Data is pretty clear on this. It is very, very hard to outperform the benchmarks over time. Now, you may have gotten lucky in the past where you outperformed in any single given year, but I promise you, if you stick with these really bad investment habits over time, you're going to be having poor performance kind of counteracting that positive performance. And it's definitely going to skew in the negative territory. So do yourself a favor, buy low-cost index funds, and don't day trade anymore. That being said, there are some small exceptions. I'm a professional portfolio manager, so I know how fun it is to watch the markets and look at the economy, and you can have a small trading account. Now, the small trading account shouldn't be more than 2 to 3% of your net worth. If it is, maybe 5 on the high end. But whatever that balance is, be prepared to lose all of it. And if you do lose all of it, be prepared for it to not impact your overall goals, right? That's the point of all this, right? You're working hard, you're saving, you're making all these smart financial decisions, so you certainly don't want to jeopardize that. The point of all this is trying to avoid the temptation to always follow the new shiny object, whether it's tech stocks, whether it's cryptocurrency, whether it's AI. It's okay to kind of dabble in it, just don't bet the farm. Goal number 4 is to make sure that you are hitting your savings target. At this stage of your life, you should have set aside 7 times your annual income amount. So let's say that you are making $200,000 a year. that means you should have $1.4 million in investable assets. Now, investable assets do not include the home equity on your house, nor does it include your emergency fund. So $200,000, whether that is in your 401k, your IRA, your normal brokerage account, your trust account, the culmination of all those investable assets invested, that's the key word here, invested in growth assets. So not sitting in cash, not sitting in assets that are not going to grow over time, because you need this to grow and compound so that you can achieve your financial goals, which the biggest goal that you're probably facing right now is your retirement. So at this stage of your life, you should be having enough assets to where compound interest is really starting to do its thing. It's hitting 8%, 10%, whatever that number is, average annualized growth rate of return. And by the time you reach your retirement age, you should have enough set aside to where you can retire comfortably and not always in fear of not having enough assets. Also, at this stage of your life, you should be setting aside somewhere between 15 and 20% of your income and setting that aside as a savings target. This can include your 401k contributions. This can include money that you're even saving into your emergency fund if you haven't established that yet. It could also be what you're automatically contributing every single month to your brokerage account. So one of the simplest but most effective ways to make sure that you actually hit your savings number every month is to automate it. Just turn it on, whether you're at Vanguard or whether you're working with an advisor. Just have that auto ACH go directly from your bank account to your brokerage account, just like your 401k contributions would, and have it automatically invested in a low-cost index fund. And I promise you, if you follow that simple rule right there, you will be light years ahead of most other people. And goal number 5 is to protect your assets. Again, at this stage of your life, you should be building a sizable net worth, and so it's very important that you are protecting those assets. And the easiest way to do this is to establish an estate plan. So estate plan is going to include a trust, and it's also going to include a will. So make sure if you do have a trust, make sure that you are looking at this every 5 years and that you're updating it. One of the biggest mistakes people make is establishing a trust and never looking at it again. It's not uncommon for people to come in, new clients, where they want to open up an account and we look at their estate plan. That's one of the first things that we do. And people will have an estate plan that they created 10, 15 years ago before they were even married, before they had any kids. And so beneficiaries are not up to date. Their successor trustee, who is actually going to be looking after your trust if something were to happen to you and making sure that your wishes are fulfilled, is that the same person that you want? So go through this, make sure your successor trustee, your beneficiaries in your trust are up to date. That also includes the beneficiaries on existing accounts that you may have. So look at your 401k, look at your IRA, look at those beneficiaries and make sure that the people that are listed on those accounts are actually the people that you wish to receive those assets if something were to happen to you. Another big part of protecting your assets is insurance. And one of the most effective and low-cost ways to do this is term insurance. It's very easy to go out there and shop around and look at 20 to 30-year term policies. And this is really just to make sure that your loved ones are going to be taken care of if something were to happen to you. Your spouse is going to be taken care of going through retirement. If you have kids, making sure that their college goals are going to be funded, goals like this. So hopefully these 5 goals are helpful on your journey to becoming financially successful. Know that we do release these videos every Saturday. So if you like this content and you want to receive more, please be sure to like and subscribe to this channel.